Hello, everyone. My name is Marissa, and I'm with Arbor Financial, and I want to thank you for attending today's session on assisting divorced and separated clients. No doubt that you've either been through a divorce yourself, have separated, or you know somebody that has, and it's a very tough time emotionally. However, the last thing anyone needs to worry about is more problems with living arrangements and financing. Today, our goal is to clarify this life event and offer solutions that fit the client's individual needs. You go to my slides. There we go. Okay. One of the first questions may be what to do with the marital property or how to make the transition to another home easier. Should we take the marital property and rent it? Should we sell it or refinance it into a loan? Figuring this out during a tough time in a person's life requires presenting options to help make a well thought out decision. That is where a great real estate agent and a loan originator make a fantastic team, you guys. Okay, slide 3. Okay, clients need empathy and a logical, non-emotional advocate to navigate financial decisions successfully. As we all know, there are many things to consider before decisions have to be made. However, working as a team, we can help many people through a challenging and tumultuous period of their life. Divorced and separated clients face some unique issues, and these issues can also be quite painful to talk about and even resolve. This is where experience counts. Let's take a look at some of the points to discuss. The first is going to be division of assets. If there are assets in a home, rental or investment properties, 401k accounts, savings, or even personal property, the parties will have to agree who gets what. Assets are great to have, but each type of asset is viewed differently in lending. Another thing is the division of liabilities. Most married couples have shared liabilities. How those liabilities are handled during the divorce and who is ultimately responsible for the liability can result in excellent outcomes or catastrophic outcomes like credit issues. I'll talk more about this issue specifically a little bit later in our program today. The next thing is going to be child support or alimony payments or receipt of payments. Here is something you may not know. As a lender, I am not permitted to ask if they receive child support or alimony payments. I am only allowed to ask if there is any other type of income that the client would like to have considered for repayment of their loan. Specifically, the Equal Credit Opportunity Act prevents us from asking specifically about alimony or child support because of discrimination concerns around marital status. If the client chooses to disclose that income to us, we can work with them regarding the guidelines required by lenders for receipt of those payments or payment of that specific type of support. On the other hand, if the client is paying child support or alimony, I am permitted to ask that question as it's a liability that must be considered when I am pre-approving them for a home loan. The next thing is going to be the disposition of marital homes and associated debt. So marital home and how it's titled along with who is on the note are details that can make or break a new mortgage loan. And I'm going to share an example with you. For instance, I have a client that wants to purchase a home but is on the mortgage to the home that her ex-husband retained in their divorce. She is no longer on title to that property. I have to show that the home was awarded to the husband and prove that the husband is the one making the payments. In addition, my client wants to take advantage of her first-time home buyer benefits because she has not had legal ownership in a home for the last 3 years. She now qualifies as a first-time home buyer. In order to do this, I have to show she has resided somewhere else for the last 3 years, the ex-husband is making the payments, and the home is awarded to him. The next thing I'm going to talk about is extenuating circumstances and credit. As much as we all hope for the best out of a bad situation, sometimes it doesn't happen that way. Arguments, hurt feelings, revenge, or lack of income can get in the way, and it can cause extenuating circumstances or credit issues. And I'm going to dive a little bit deeper into this subject in detail a little bit later in the presentation. How the client works through and is guided through these unique issues will either result in a situation where someone can or cannot get financing for what they're looking to do. Let's take some stress out of that situation and talk about details clients should think about first. Okay. The first place to start assisting a client is gathering all of the facts, whether decisions have already been made or whether a client is seeking options for those decisions they are contemplating. This fact gathering step is critical for their success. Sometimes assumptions are made that if the couple's living in the home together, they're both on title and the note. Those of you who have been in the industry for a while know that these are not always as they seem, and it's not as simple as it seems. We tend to see all sorts of variations in this area, such as one person is on the note, or both are on the title, or one spouse is on the note and title, and the other spouse is not on anything. Who is living in the home, how long they've been living there, or who is not on the note and title can make or break a refinance of one party if one party does want to stay in the home. Or in the case of a veteran, this is a little bit different. If the veteran quit claims from the property, their eligibility is still tied up in that property, which means they cannot use VA financing on another home purchase. So as you can see, it can get a little bit complex depending on that person's unique situation. Do they have legal or financial counsel? Clearly, we are not tax or legal consultants, and we don't want to put ourselves in that position. However, if they have legal or tax consultants, I do like to work with them directly to help structure a mortgage based on that client's desired outcome. Have they thought about whether or not they will keep the house, sell it, or even buy something else? It may be easy to decide that between all parties. But if it's not structured in a way that can result in both parties getting their own financing, it can result in a bigger issue for both of them. If the couple has minor children and discloses child support, then a lender will consider the ages of the children and the longevity of the child support used as income. Generally, lenders are looking for support to continue for at least 3 or more years. And if alimony income is disclosed to the lender, then the lender is going to work with the client about using it as income or consider it a debt, depending upon what situation they're in. When alimony or child support liability is disclosed, lenders will consider this to help the client pick the right program based off their needs, as there are variations of loan programs and how the lenders are going to handle each type of debt. Lenders are also going to look at all agreements that are in place already. Again, I cannot stress this enough. It's important to talk with a lender before making some of these decisions, as many people are so disappointed that they cannot buy in their own place because they didn't know what they didn't know. They didn't know some of these details that were out there. Okay, one of the most important details in a divorce or separation is whether or not there is a legal agreement in place. Lenders like agreements that are formal, written, and court-ordered. Those agreements are the only way lenders can demonstrate good risk decisions and borrower stability regarding their assets, income, and liabilities to approve a loan. If agreements are not formalized or court-ordered, then the lender may not be able to proceed without that, and it really depends on the client's situation. For instance, if a formal agreement exists and say spouse A is responsible for the house payment, even though spouse B is still on the note, the lender does not have to count that payment against spouse B because the agreement is court ordered. However, if it is not court ordered, the lender must count that house payment against spouse B. And unfortunately, there are not many people who can qualify for two mortgages at one time. If a client does not need to disclose alimony or child support, let me rephrase that. A client does not need to disclose alimony or child support. And as stated earlier, as the lender, we cannot ask if the applicant receives alimony or child support. We can only ask them if they have other types of income they would like to be considered for the repayment of their loan. However, we can ask if the applicant is required to pay alimony or child support, as this would be considered a liability, and we have to use that when qualifying them for a new mortgage. If a client discloses that they receive alimony or child support, the lender may be able to use this income. However, alimony and child support income are treated very differently. A lender also considers the longevity of the income and how long it has been received. Since there are guideline variations in this area, one program might work a little bit better than another program. For instance, if I can show that I have received 3 months of child support or alimony, then I know that FHA or VA financing is going to be the program that I want to use for my borrower. However, if I received alimony or child support for only 6 months or more, then I know that that's going to open me up the availability to utilize conventional loan options. If the court-ordered agreement states that the payments are voluntary, then this income could not be used on conventional loans, and it can only be used on FHA loans if I have a 12-month history of receiving it. Lenders must also document that the receipt of that income, and that can be a little bit tricky because if a client is not counseled properly before they consider applying for the loan, we don't know if they're going to have the right documentation to supply when utilizing that for qualification. I've seen circumstances where the payments are paid in cash or only partially paid because one spouse deducted an expense or is simply sporadic payments and they're not paying consistently all the time. The best counsel is to make the client aware of how lenders are going to document the receipts of payments so that we can be sure that we can show consistent amounts on the applicant's bank statements when we're reviewing all their documentation. Lenders will also treat alimony income and child support income very differently. Alimony is considered income under the IRS rules, therefore it's taxable income. Child support is non-taxable, and because lenders base their qualifying ratios on gross income, we can adjust that income upwards. To do this, we're going to add either 15% or 25% to the client's adjustable grossed up income. And it really depends on the program with how much we are able to gross up that income amount. But that little bit of income can mean a huge difference between an approved file, a higher pre-approval amount, or even it can lower the rate for the client depending upon debt to income ratio requirements. Okay, next we're going to take a look at the client's liabilities. This is usually pretty easy to consider when you're single or married. However, divorced or separated clients may have commingled liabilities, and listing the debts in legal separation and divorces can help clear up the responsible parties to help them qualify for their home purchase. So the first is how many months are left. One common question we received on divorced clients who have been divorced for a while, or whether or not we need to count a liability such as child support or alimony when there are fewer than 10 months left. For the most part, lenders are going to count this as a debt. However, some programs consider the assets or the impact of the debt. So it's important to always ask before assuming, because there might be instances that we don't have to count that debt for the client. Voluntary versus mandated payments. Voluntary payments and where the applicant has no legal ties to the creditor will not be considered by lenders. As an example, a former spouse agrees to pay off a credit card voluntarily, that's not court ordered, and that person is not officially obligated to the creditor. Because this is a voluntary and not a legal obligation of the divorce or separation agreement to the creditor, the lender will not count that against the person voluntarily paying the debt. The bottom line is that it's not mandatory. And if it's not mandatory, and that person can technically stop paying it at any time, so we don't have to include it. Contingent liabilities and debts paid by others. Lenders are going to look at secured debt liabilities and non-secured debt liabilities completely differently. We're generally breaking these down to contingent liabilities or liabilities and debts paid by others. So when a borrower has outstanding debt and that outstanding debt was assigned to another party by a court order, such as under a divorce decree or a legal separation, and that creditor does not release the borrower from the liability, the borrower has a contingent liability. And the lender, I'm not going to require to count that against my borrower when I'm looking at their recurring monthly debt obligations. The best example of this is going to be a house payment. Once again, how this is structured is important to the type of loan that a borrower can obtain. For instance, Fannie Mae does not require that a person was removed from title, but Freddie Mac does. Now, while that may seem like no big deal, there are many, there may be another file issue that resolves in one use of one program than the other. So if something else comes up that can't go Fannie and I have to go Freddie, then that could result in an approval or denial based off that information and what we need to make sure we're satisfying those conditions. So it can complicate the approval process a little bit. Again, this is another reason why lenders counsel is super important when we're pre-qualifying so that both spouses can move in a direction that they would like to go. Debts paid by others. When a debt is not mortgage related, such as a credit card, even though another party may be still obligated under that agreement, the lender will still count that debt as they can show that someone else, unless we can show that somebody else is making that payment for at least 12 months. The next thing is going to be quit claims. Quit claims. Be warned that simply quit claiming a person from title does not eliminate the liability. Let's talk before you advise on this because the liability is still present at that time. Okay, you can probably imagine that credit issues can arise with the turmoil of a separation or a divorce. It may be on that primary wage earner. They might decide to stop making house payments because they left the house, or that two residents cause that financial stress. Lots of things can happen during this time. And this is what lenders call a life event or an extenuating circumstance. Basically, it means that a blip happened on your credit and it's not an indicator of your credit history before the event or an indicator of your credit history after this event. Depending on the circumstances in the loan program, a lender may need to approve the loan manually, or they may be able to get the loan approved through our automated underwriting system. That may sound like no big deal, but it can be. For instance, lenders have less risk if the loan is approved through automated underwriting because it means the investor will take the loan. However, if a loan has to be manually underwritten, this can mean more risk for the lender. And if the lender reviews a file manually, we're going to take in consideration all of the credit problems that occurred during the divorce. Has the person reestablished their credit after the life event? Have they been paying things on time? Life's not perfect, and lenders know that. While the situation requires a little bit of finesse, there's ways to work out temporary life events if this does happen. So don't lose hope for your clients, and let's get those facts straight and those decisions made, and just make sure we're documenting everything appropriately in order to move forward on a manual underwrite should we need to. The last important point regarding this subject is the difference between conventional loans versus government loans. While FHA and VA do not consider extenuating circumstances, and Fannie Mae and Freddie Mac do, it doesn't mean that a client should apply for conventional financing. Even though FHA, as an example, doesn't consider extenuating circumstance, they are a little bit easier to deal with on credit issues and derogatory waiting periods. They're a lot more lenient. This is another reason why educating our borrowers and us as the lender, we need to be able to assist the client and advise them as to what types of programs are going to work best for their situation. So don't Don't get rejected when, you know, one loan program comes up and we can't do another one. We don't need to reject them automatically. We can take and work it out for the specific program requirements for each conventional FHA, VA financing, USDA financing. Okay, you guys, before we finish this up today, I want to take a look at some of the common situations that I run into as a lender. So the first one's going to be if an applicant cannot document 6 months or more of alimony or child support, and they need that income to qualify. FHA or VA is going to be their option. Another one is if the child support is voluntary and the client needs that income to qualify. Only FHA will take that loan with documented receipt of that income. Another one is if the client needs to gross up child support income and they need every last cent they need for income to help with their max pre-qualification amount, then Fannie Mae and Freddie Mac for conventional financing, they're the most generous for those gross up amounts. We can take that income and we can gross it up 125%. So say a client's getting $1,500 a month in alimony, or I'm sorry, not alimony, that's taxable, and child support income, we can gross that up 125%. And instead of 1,500, we're now using 1,875. So it's quite a bit of a difference that we're able to utilize if we can use conventional financing in that. It's 115% on VA or FHA. Another one is going to be if the title has not been transferred out of a client's name, but the other spouse must pay that house payment based on the arrangement. If that's the situation, then Freddie Mac's going to be the best solution, not Fannie Mae. And those are both conventional programs. Fannie Mae may be the way to go if there's extenuating circumstances, as their automated underwriting system will accept extenuating circumstances. It can read that information off a client's credit report. If it's approved, the client will not have to go through the manual underwriting process. And manual underwriting is just more documentation requirements. It can also increase the interest rates. So it's we try to avoid that as much as we can, but we do have the capability of being able to do that for a lender, as a lender. Okay. I hope that you guys enjoyed our time together today. I know that was a quick, 20 minutes, to share on some of the tidbits and informations on helping to increase your business a little bit and just dealing with some of these harder situations that we do come across. If you have a client that are thinking about divorcing, or they're reaching out to you as an agent and they want to know, hey, what are my options? Get them on the phone with me, because there's so many different things. We want to make sure, when I'm talking to a client and they call me and say, Marissa, we're looking at going through a separation, but they're divorced. I can say, hey, okay, this is what needs to happen. Pull your credit reports in your divorce, or your legal separation. Make sure all of these debts are listed, for him or for you, and point out who those responsible parties are. So there's things that we can go over to help prepare them for the future and prepare them to become homeowners. If we know that people are going to be wanting to list their homes and are thinking about it, or, say a spouse wants to stay in the home, so we can navigate and really set them up for success and strategically plan out their roadmap on how to do this so that they can both purchase later on. Okay. I hope you guys enjoyed this short webinar. You are going to be getting an ebook to refer back to that we'll send to you within the next couple of days. And next month, I am doing a first-time homebuyer webinar, and I am bringing to you I'm the premier lender for the state of California for the new 20% down program that just rolled out. And I'm going to be speaking on that in early April. So make sure to join that. And if you have any questions, please reach out to me. I'm here to support your business. Okay. Have a blessed day, you guys.